The following is a presentation of TFNN. The Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi, everyone. Just finishing the touches here to show you something very interesting. Let me just check if I missed it by a... Nope, that's exactly right. Talking about plumb lines right here. Yep, the plumb line, just as if you were a carpenter and you need to draw a straight line down. You'd pin the string to the wall, and the weight would take the string straight down, and you know exactly, and you go plop, and you get yourself a chalk straight line. Well, that plumb line in the E-mini went from 1804.25 at 2 o'clock on the 20th of January, and that's the day that we switched to the long side of the Dow, and went all the way to the high of 1940. That's a huge move. 140-point move to the high of, at the close on the 1st of February, and then came down sharply. And then the other day, what was it, Monday, I think it was, time's flying, we switched from the long side to the short side of the Dow. Now what we're looking at is something very interesting. Time price, 120-minute chart. If I draw this, I like to have clean charts, but when charts are very informative, when they've got all this information, it's kind of important, at least for a little while, to keep it there, because subscribers, I show this every day, like to look and see, what am I going to do? Let's make it a color that's very bold. Let's make it blue. Make it blue and make it nice and thick. Look at this. Like the weekly chart of the Dow, the umbrella weighting. Right there. The weighting of the arch formation is so powerful that we have gone from 1804.25 on the 20th of January, 2 o'clock in the morning, afternoon, to moments ago where we went to 1802.50. We went 2 points lower. And then the rule of thumb in the Chapman wave methodology is that the bar that takes out the left side low has to close above the left side low and attack, really attack is the word, because it has to spiral quickly up to either a left side peak of consequence or a moving average of consequence or a gap, but there has to be a focal point. And that focal point was at 1826, the 9-period moving average, and we've gone twice now above that level into the 1833 and then 1832.50 area, only to plunge right back down again. This is one of the most important phases. And one of the reasons is, and yes, I got an email just describing it very well. Paul says, let's see what he says. He says, Basil, our markets are now in big trouble. The Federal Reserve made a huge mistake raising interest rates back on December the 9th. The banks are now trading below book value. Even Jim Cramer can't figure it out. I will be the first to tell you that we're in the early stages of the banking system collapsing. Actually, Paul, you're not the first. There are a lot of people before you, but I understand your commitment to that theory. I will listen today to see if you even mentioned this. Well, yesterday, remember what I spoke about? I spoke about if gold is going higher, we've got to consider what's going to be happening in the financial sector. Yes, absolutely. So, okay, here's a chart, very important chart. 120-minute E-mini says we have gone. Tested the left side low of 21st of January. It's now a few weeks later, and we've retested it, and we're trying to bounce away from it. If there is a close below 18, let's just make it a round number. If there is a close below 1800 in any of the 120-minute bars coming up for the rest of the day going into this evening, be careful, because this trend line right here says that the next level of support would be the 1785, 89, 85 area. Okay, enough with that. Let's just get to the numbers. The Dow right now is trading on, I'm going to do the charts at the same time. I was asked if I could expand the charts for some of the descriptions that I'll do my best to do that. But right now, I want you to see The daily, the weekly, and the 120 moving out, putting it in the corner, and the monthly right there. So here we go. Dow. The Dow right now is down 311 at 15,601. The arch formation that goes to a lowercase h did not make that lowercase m that I said was just a possibility yesterday to subscribers. In fact, it broke down. And now what we've done, and we're looking at 15,601. Once you get into this Roman candle right there, the wick, halfway into the wick, that's exactly where we're trading right now. So if there is a close on any of the 120-minute charts below 15,600, and we're at 15,595 right now. If there is a close on any one of those bars, be careful. I know a lot of people are looking for some kind of a rebound today. I think it's a little early. And if it continues like this, we could see the volatility index scream into the 30s. What is it at right now? I should have looked first, right? It's at 28.71. Scream to the 30s. If there is an ugly close today and then an ugly session tomorrow, we could go right into Monday. Monday to Tuesday, we could see some kind of a rebound of significance. Not the rebound, but a rebound. And then when I mean significance, I mean the daily chart could then start another H formation. All right, let's just go on here. So the resistance right now is the 15,650 to 15,720. If there is a sudden rebound at any point, it's actually better that there's no rebound now. That in the Chapman way, the Roman candle, one of the reasons why I've spoken about this so often is that candle of January, we're way into the wick. There's now in the monthly chart a huge, a 95% chance that we will test 15,450 in February, probably break it and have to test 15,370. That's just the way I'm looking at it right now. Let's go on. S&P. S&P right now down to 32 at 1819.47. It has not broken the low of the left side of the 22nd. This is a very, I shouldn't have said 22nd, I meant 20th of January. Don't know why I wrote that in, of 12.21, but it's getting close. This is 1819, so it's got 7 points to go to break it. We're almost at the low of the day, but it's the Roman candle, and that Roman candle says at this point there is really little chance that we will not break 1812.21 in February. Not with the way the MACD and stochastic are so poor, and the same thing in the weekly chart. Now the weekly chart is something very interesting. It has a left side, right side price time match, but it goes to this bar right here of 2044, the low of the week of the 10th of July. If I use that as a midpoint, that's not the plumb line that we always like to use, but it's a plumb line. Nevertheless, it's the one that I call the moving plumb line. And that takes us to it can go all the way to end of March before testing 1812. I think this is the acceleration phase. Remember, markets tend to move in very symmetrical arch or cup formations, or V-shape or inverted V-shape formations, except for those moments when there's a bear phase, and in the bear phase they can accelerate. So let me just go on real quickly. The comp index is down 67 at 42.16. Gold is up $54 at 12.48. The silver's up 47 cents at 15.70. Crude oil is down at 26.54. Bonds are up 2.5 points. No, almost 3 points. I'll be back because the dollar is down. I'll be back straight after these important messages.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com. The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Basil takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
All right, folks, so let's get back to the volatility index. The volatility index right now, the VIX index, is at 2883, up 2.54, up 9.66%. That's a big move. It's only in leg C in a new mistake. It's in leg D. How on earth did I miss that? A, B, C. It's in leg D in a, and what we call it in the Chapman Wave methodology, an inside buy mode. And one of the reasons why this is so important is because it has to go all the way to 32.09 to even touch the previous high. The high of what date? The high of January the 20th. So if it's going to go forward, well, now it's 29, so it's 3.75 points, 3.25 points. If it's to get that, look, we've just gone from yesterday's close of 26.29, only 2.5 points, less than 2.5 points. To get those 3 points or more than 3 points, if the Dow is down 300, the S&P is down 32, the New York Stock Exchange, NYA.X, the New York Stock Exchange is down 1.92%, down 176 at 9,000. I suspect that you're going to have to get a lot more points to the downside. Oh, and I was reminded, of course, I knew that earlier, and then I completely forgot. Is Monday's a holiday? Oh, isn't that interesting? Monday's a holiday. So we can have some confusion here for a little bit. So let me put it this way. If there is just a modest rebound today, 150 points off where we are right now, so the Dow closes somewhere around 15,750s, let's say. That's not good. That's not a climactic reversal. To get I suspect we're going to have a number of climactic reversals. Remember, I've spoken very often about the internal low and then the residual low. My thinking here is we're going to make a number of internal lows before we make the residual low, and that they're cumulative, and that there's a rotation going on. And this rotation is including, in some form, it's including certain sectors, but it's the sectors of fear, gold and silver. And that's the reason why I don't think that this is the time to be putting on longs And it's just the real quick intraday trades and stuff like that. But we've got a long position. We have a couple of long positions, but one is in a defensive area, and I'm expecting that it will get taken out. Dividend stock held beautifully. It's had a spectacular run in the last week. Holding not bad. It's only down 20 cents on a $36.5 stock. That's not bad. But boy, the old Granville thing is when you get a bear market, it takes down 90, he used to say 92, 95% of stocks. We've got different kinds of markets now, so that number is not always reflective of a full bear market. In the main, eventually you will find that majority of stocks have gone down. But at this particular point, we have so many stocks that are, I'd like to say, in their own world, but in sectors that could, for instance, potash is rallying right now. Doesn't look great, but it's up 33 cents. So in a sense, you've got some divergence, and you've got some divergence because some of the commodity areas, some, not all, but some of the commodity area are moving quite nicely. So let me do this. I want to look at the dollar because we've looked at the dollar and said that it's made some kind of a top that is very important in the weekly chart. And that weekly chart is now confirmed that was an alternate count, and we're going to call it an F. And because it's an F, you've got your one-to-one expansion in the weekly chart. It's gone even greater than a one-to-one. This is just not good because it's saying that the one area of support is starting to fail. And that says that the dollar is on the way to test the 94s to the 92s. That's going to be a major area of support. And that says that gold, gold, in fact, even though it's gone parabolic in the weekly, off a low, not a low, I shouldn't say it's off a low. It's gone parabolic off a down move. And that was the lowest low in the cycle. Remember, this one never ever had that crash formation. It just was kind of bouncing in a downhill, like my hill over here. And every time the ball hits, it's going to go to a lower level. But it's got a nice platform, and that's exactly what happened. It's what we would call a stair-step move to the downside. This break to the upside has just wiped out 1, 2, 3, 4, about 5 or 6 or 7 or 8 or 9, about 9 months of downward highs, lower highs and lower lows. So this is something you've got to respect. So if I put this together with something like the XLF, which is the financials, you've got that candle from August. We're into the body of the wick of that candle. And that's saying that there's a really good chance that the XLF, before this is all done with, is going to test the low of August of 18.52. We're at 19.66 right now. And if that's the case, if it breaks under it, then you have to establish some kind of a base. And the MACD is poor, but not horrible at this particular point. The stochastic is dropping sharply, and the on-balance volume is way down in the 40% area. This is just not a good sign. And it's saying that if you've got key areas, in this case financials, declining like this, you have to be very careful on the long side. So get that out the way. Now, within the context of this particular market, let's just go through other sectors. Look at the IYR, which in a way it held kind of okay for a bit, and then it started to fail and broke the 200-period moving average. All of a sudden this week, not only that, it gapped below. The IYR is the iShares of the Dow Jones US REITs index. This is the commercial real estate. And it's got a look to it that says 1-to-1 to the downside. The more I'm looking at this, the more I'm saying, what on earth is going to get us into a buy mode, not just a buy signal, but a buy mode in the monthly chart, that it can't be done unless it's just almost like a single leg up, spiral to the upside, fueled by the Fed or fed by the fuel. And that's the only way I can see it. I just don't understand what's going to do it. And I've got this outstanding, in fact, even this morning I was looking up certain things that would be, for me, icons that I look at in the building area, etc., that would confirm for me that this is it. This is the top. This is the top I spoke about. This is the top that forever, that this is where capitalism comes under such pressure that we go down for multi-years and maybe even a decade. I just don't see that this is the moment. And now, am I thinking emotionally? Am I thinking intellectually? What am I doing? How can I even think that we could make new all-time highs? 18,351 in the Dow when we're trading at 15,572. It's only 3,000 points, not only, it's 3,000 points down. I say only in the context of where we've come from, the 6,500s. So this is what we would call a normal period of consolidation after such huge breaks. But I'm looking at monthly charts of so many indexes and key stocks that are saying, hey, the top we just made is a serious top. How do you square that? The way I square it is to say we're going down, and until we finish going down, we won't be able to look at the upside. I'll be back in a minute.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
So a statement was made after I said that about what on earth could set off a buy that would be powerful enough to even attempt to get to the all-time highs. And the question, statement here, if I can just find it, is maybe the excess is in debt and not buildings. We are tapped out. Peaky said that, and I have to tell you, when I look at the figures for the debt, it is phenomenal. They are excessive to the extreme. And that absolutely could be it. Now, I always have to go back in going into the year 2000, my anticipation was that the Dow would go up into the 17,000 area or even higher. Only afterwards did I figure out, wait a minute, what were you talking, what were you thinking about? All that money that normally, historically, from time immemorial, from the 1880s, that would go into the Dow, went into the NASDAQ, went into those high techs. That's how that top was made. And then in 2007, I understood that it was the real estate area that was essentially curtailing the big move in the Dow. That money had gone into real estate, so the stocks were of less importance because real estate stocks and real estate itself was the major bubble. So that says to me, now we've got to be maybe looking at maybe debt, maybe it's other things that are creating this phenomenon. And if I look at it in the aspect of throughout the world, what is happening, you remember for over a decade now, I've been talking about the Japanization of our bond yields. If we're looking at the context of yields, and if we're looking at the context of commoditization, which is something that I've liked to talk about for a long time, that just about everything is commoditized, then what we're looking at is within that context, perhaps you've got to be aware that commodities have been commoditized themselves. That's why gold pulled back so sharply and the other commodities. But yields are treated as a commodity now. When you've got competition around the world, it says competition is for the lowest yield. And look, there's no change in this multi-decade. Going back to the channel, it goes back to 1986. But the actual top is September 1981. In the yields, and the yields are still making lower highs and lower lows. That is something that you have to consider is an imperative when you're looking at the economic structure. All right? And if you put it together with the spending, and a lot of the jobs that were formed over the recent years have been government jobs, when you put this all together, the complexity of our economic structure is such that what used to be the norm is now not the norm. We've got a different norm, and therefore your expectation and your analysis has to be based on other things. So I'm looking at it and I'm saying, okay. Traditionally, I'd be looking for the skyscraper phenomenon. You want to know about the skyscraper phenomenon? I wonder if this is it. Yep, there it is. This is just Boston alone. These are new projects. No, this is not even updated. This goes back. So construction projects in Boston. Look at this. There is Filene's, the new Filene's. It's actually a very pretty building, and it's right there on the Common. I mean, this is amazing. Look at that building. This is in a city that used to have not that many skyscrapers. When you flew in, it looked like a big college town with a couple of skyscrapers, not even skyscrapers, just big buildings. So that's the Filene building. 426 Washington Street, the Boston Convention and Exhibit Center. All right, they're hotels. These are the hotels that they're putting up. 400 to 500 room hotels. So where is the glut? Where are we looking at the Boston Scientific Way? I mean, this is amazing what's going on. Boston Scientific will move 800 employees to Marlborough and sell its massive Natick office complex to MathWorks, fast-growing software company that will nearly double its office space in Metro West. There are things going on here that just the Rose Fitzgerald Kennedy Greenway, a whole bunch of things going on there. These are major projects. Lovejoy Wharf, look, this is on the wharf. There were no buildings there. So we are getting the skyscraper phenomenon all over the show, all over Boston, all over the world, actually, I hear from people. Trinity Place, 40 Trinity Place. A lot of these were on hold, and now they're being all the papers have been passed. Boston University School of Law. Look at this. This is Boston University. You should see a lovely building for the Mass College of Art. And now, look, this is our harbor. This is Pier 4. Pier 4 used to have Anthony's, a restaurant, old-fashioned restaurant, Italian restaurant. It was the hub that people used to go to for business deals, etc. Gone. Now you've got these complexes. So the structure, when you look at cities and you look at major changes in the structure of the city, especially if you're looking at height. You know that all legislation becomes, it all gets changed because money changes hands, and income from taxes, etc., become almost like an immutable magnet for government to say, oh yeah, we'll change our laws to pass that because we're going to get such big revenues. Well, all around the heights of the buildings, all the laws are changing. New England Conservatory, here it is. This is the building that we're talking about. They put the shovel in the ground last year, almost just a little after the market top. I mean, I've been talking about this for 10 years now. It's really 10 years. It was before the crash of 2000, before we turned around in 2007. I was talking about this. I even had a meeting at the conservatory and said in October of 2007, be careful. Our history is that we built at tops. In 1929, they built Jordan Hall, an extension of this beautiful. Jordan Hall was built in the late 1890s. And then they added the extension of Williams Hall and Brown Hall in 1929 when they were flush with huge endowment. 1952, virtually insolvent, and they went from 4,600 students to 1,300 and something students. But the building is there. And it's for the next generation. So I'm not talking about that they shouldn't ever build. I'm saying that it's ironic that these things can only get done at market tops, because that's, oh man, I could go into this whole thing of these young students talking about free this, free college, free that. How do they think that they ever got the scholarships, etc.? They got it from the money made in stock market, etc., that is donated. The Tisch building, you can go on and on and on. For New York University, go right through every single university. The money that's donated is donated. It isn't given by the government. It is donated most of the time. So there's an irony going on here. And that's why I wanted to go off. All right, enough of that. We're out of the way there. And we're going to go back to the TYX, which is the 30-year T-bond yield. And that T-bond yield is arching over. Where will it go? The way it has this momentum to the downside, it suggests that at 24.22, there is a chance that we could get to 22.26, the low that was made January of 2015. But that's where a lot of information is going to be imparted to us. All right, enough with that. Let's just get on with our story. So, stocks. I want to look at GG. Leg C to the upside. This is Gold Corp. Just 3 months ago, trading under 10. Now it's 50% higher, 15.57. Something's happening. Gold is telling us that something is happening. And I'm with you, Paul. Something's happening that we've got to respect, that the financial sector, Goldman Sachs, will go from GG to GS. Look at that chart. Exact opposite. I'll be back straight after this break.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date active trading information that will will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Just to clarify something, the picture I showed you right here of the new Conservatory of Music, that's Jordan Hall. It used to be right here, well, there still is, a dormitory and a library. This is coming down, and that's being put up. I just want to do that. There's a space behind it. This is off Gainsborough Street and St. Botolph's behind it, and this is Huntington Street in the front. So there's a great history. The Boston Symphony Orchestra plays in Symphony Hall, which is just a block away, corner of Mass Ave in Huntington, one of the great music halls in the world. And up further, I was speaking about the Mass College of Art. A very interesting dormitory was built about a few years ago. Very interesting. And some new buildings. All the institutions around here have been building new structures. So I wanted to point that out. And it's just a lovely building. And the designer, Beher, I think is the name of the architect. She's gone into the environment. She's done all the stuff. I mean, everything about it is just fantastic. Well thought out. Energy efficient, a landmark building, a beautiful structure. The design is, they wanted to make a statement. They're making a statement. Right over here next door is Northeastern with a huge building. They had to actually pay the conservatory and the YMCA right next door are fortunate to be able to put up that building because of any structural damage that might occur, etc. And a lot of building. And it's just, I'm talking timing, that's all. So then I got an email saying, stop waiting for skyscrapers. The market is going down a lot more. Well, I think that's correct in the sense that, yes, it's going to be going down a lot more. But I'm still waiting for one particular sign, and we'll see if that particular sign ever comes out. We'll see. All right, Goldman Sachs, look at this. Almost at 141.67. It's only got 5 points to go to the 200-period monthly moving average that it never even looked back at once it broke out in December of 2012. So these are significant. There's the Chapman Wave Roman candle, took it out. So as we're looking at this, my thinking right now is 2 things. One is the volatility index, the VIX index, is up at 28.81. But I wanted to show you the cup formation that's forming, but it's already in leg D, number 1. And number 2 is in the weekly chart, leg D only starts above 32.09, that high right there. The high of the week, that was the January 20th high. And so you've got quite a few points to go. So that's number 1. And we might have a little hiatus on the way, because now that I'm thinking about it, we're going to go all the way to Tuesday after the long weekend. Normally, if tomorrow was bad, we'd just get this bad news event over the weekend, and we'd have some major sell-off on Monday, and then maybe a turnaround, another one of these ictuses that says, okay, another internal bounce-off point. But still within the context of lower lows and lower highs. Meantime, back at the ranch, it's this monthly that really I'm looking at, the volatility index in the monthly chart. A lot would have to happen. The Dow would have to actually rally 1,300 points, maybe 1,500 points, to see this volatility index get even close to the 22s, and maybe touch the 9-period moving average of 20.46. Actually, I think it would probably have to get closer to 2,000 points to get all the way to 20.46. Depends on the suddenness and the daily rigor of the markets, because if a bounce at any point in the next day or so from about this level, even a little bit lower, if that occurs, it has to be almost a straight up move to get the volatility index to really come down sharply. But it isn't leg D, and I have to respect that in D you can get certain things to happen. Look, the stochastic is only at 67, it isn't at 80. MACD has turned positive, but it isn't expanding. With the histogram, it is expanding, but it isn't at the highs that it was at when it hit 32.09. So at this particular point, I'm saying be very careful. And remember, we've been speaking for a while saying if you've got some kind of a portfolio and funds, etc., there's just no harm in even now taking a little bit off, having something ready to put back on later on. Because there's so much damage done now that even if we were to bounce, we'd have to do some retesting. So there's no real rush. But at the same time, my biggest question here is this done? Is this it? And I'm not talking about it for a month or two or three, or even going into the summer. Is this it? Have we seen all-time highs that will not be seen for a long, long time? Something tells me no. I just don't think it is. I don't know what that something is. I'll have to sit down and figure out. I'll have to do a little some therapy on myself and say, okay, mister, talk it out. Well, what are you looking at? What's the problem? But in the meantime, we've got to consider that this is a very, very vulnerable market. Now let's look at a couple of things. Look at my Dow quartet. GE, whoa. 27.48 was the key left side support. The low today is 27.75. We went down by 3 cents. So the arch formation, remember in the arch formation, the bar that takes out the left side low, that bar or maximum, the next bar, you have to close above 27.48 and you have to try immediately to rally to some significant high. In this case, it would be the 28.25 9-period exponential moving average, or the peak A minus that was failing right there on the 10th at 28.70. That was yesterday. The monthly chart is starting to weaken. It's a peak E top. I got to respect that weekly chart is not looking good, and it's gone down to a leg B now. And this is the candle that we got to watch with the gap below it. And it's the candle of October of last year, the week of the 9th, low of 26.22, high of 28.20. That's the candle, because below it, you've got a gap. Once you get into the gap, immediately 25.19, the 200-period moving average is your target. And believe me, over 2.5 points from here in GE will spell at least 400, 500 points, I believe, in the Dow. All right, so the upside, if in fact it succeeds by tomorrow in reversing back up, and today it doesn't close below 27.48, or at least by tomorrow it closes above 27.48, the balance says at 28.20s to 28.40s. It's got to get above there. Otherwise, we're just going back down in the H to lowercase m pattern. All right, IBM. I'm including IBM here, but I really shouldn't. It's just in a major bear market. IBM is in a major bear market. It's below the 200 moving average in the monthly of 127. It's trading down on $1.91 at 118. Just not looking good. And we could even get a new recycle in the weekly chart. And this would be G/D. It would even possibly be A, B, C, D. Yeah, it could be a new count to the downside. Whoa, talking about counts. This could be a G. Now, this is the 7th. That's the 7th wave down. 7th peak to the trough to the downside. And the 7th peak to the upside is what we always look at and say that's where you got an alternate count, but you often get really big reversals in a G. Steve Rose is going to be talking about that within the Chapman wave, but within other contexts of other techniques that he's developed, built on the methodology of many standard techniques. So that's going to be tonight. Tonight, yes. tonight, check the front page of TFNN for Steve's very comprehensive workshop. He does great workshops. He has all these charts and he has a couple of funny things. It's great and a lot of education. So please check it out. Okay, IBM. So now we've got Triple M. Triple M had a fabulous move to a PE in this W formation. It's the one stock that is actually looking pretty good even now, and then UTX. And UTX is failing. So you can't just base everything on this one stock. I'll be back. Basil Chapman, Dow's down 363, S&P's down 35. Be right back.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Learn how to trade options with swim lessons. Brought to you by TD Ameritrade. Think or swim. Next on TFNN.
Hi, folks, we're back. Now, let's just have a look here. We've got Chapman Wave projections, 1811 to 1808. It's held so far on the E-mini in the 10-minute. We could be having another little bounce, the old lunchtime bounce. Let me just check over here. It made a peak C. It looks like a C minus could start a brand new attempt, and we could have the M-shaped pattern here. The fact that there is buying coming in and the buying has failed tells me that a little later on, if that support holds, you could just get another spurt of buying towards the end of the day. Every spurt of buying without having a climactic volume reversal says to me it's just making it gives you a greater chance of going lower. So I would like some climactic reversal and then a rally of 800 to 1,000 points in the Dow. And then we check out like a sieve. You want to see what stocks have held and what stocks are failing, what stocks have failed to rally and what stocks have kept going down during the rally. or where was the leadership? So in this particular instance, I'm looking at Nugget, which is the basically a very high-level trading vehicle for the gold miners. It's direction daily gold miners 3 times bull, and it's gone from the 18, I think somewhere around, we just missed it, I know, it's 1740, here's the low on the 19th. We missed it by just a couple of cents, never got back in. Had an opportunity, didn't take it because the moves are just so quick. And it went all the way to today's high of 54.80. I would say that that's a big move. 17 to 54. Threefold. Okay. So what we're looking at here is, yes, it's a little bit overbought, but that's not the issue. The issue is, let me just do this. I'm going to go to gold because most people would be looking at gold. Gold itself has gone way past the October high. The NUGT has stopped almost at the October high. Oh, I'm pleased I did that, because we've got, this shows you how the direction shares work. They're trading vehicles, and to hold them as a longer term, you really have to get the trend fantastically to garner the greatest profit. So in this case, you've got a high of 52.60 in October, and what did we do today? We did 54.80. So a close below 52.60, a close below that says, oh, be a little careful, we could be pulling back. But wait a minute, you got to look at the dollar, because there is that relationship. And the dollar is in leg B down very quickly, leg B, in the, this is in the weekly chart, daily chart, I'm sorry. The daily chart, stochastic is close to some kind of a bounce. The MACD is not really. And it says, okay, dollar at 95.47. There could be a bounce to the 200-period moving average at 96.60. And we'll see what happens. So I want to be more nitty-gritty. Let's just do it this way. I like doing this because I think I get a word from you that it helps if you got the VIX index. VIX at 28.67. For there to be a sustained move, it's no good for the move to occur with the Dow going from minus 320 to minus 265, then 255, then 230, minus 235, when the VIX index is still in the 28s. You want to see a rally that goes, especially since this is leg D, that the rally in the VIX fails and it starts to go 28.50, 28.30, 28.20, 28, 27.90. As our market has a spiral to the upside, and they'll say, great, got another bounce coming. The volatility index is still going to probably hold above the 9-period moving average into tomorrow. So this is just a bounce, but that's what I'd be looking for. But the other side of the coin is if there is further selling, and this VIX index climbs into the 2930s as the market takes out the low of the day, be really careful. I'd prefer to say to you, be careful of a double to the downside, maybe not a double, another 300 points, but a big move to the downside with that VIX rallying than any spike to the upside in price with the VIX fading. I'd be more careful of a decline than.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.